If start of the year, I would have started this panel, I would have said, how's the Josh? And you would have said, hi, sir, or hi, ma'am. Is it the same Josh, the same level of optimism when it comes to equity markets?
In the market, for sure. While there is a bit of disconnect between what we are seeing in the economic data and what we are seeing in the market, which is not illogical because markets are forward-looking. We're also part of a global reflation trade. Globally, central banks have printed so much of money fearing a recession, while the overall economic data has been reasonably okay, which is like a very happy situation for most of the equity markets globally. India has also benefited. We have got positive flows. Markets are also enthused that given all the recent steps that have been taken by the government and most of the other reforms over the last few years, next couple of years, earning growth should normalize. Last 5 or 7 years have been a complete, I would say, a big disappointment on the earnings growth side. That should normalize over the next few years. And as I mentioned earlier, markets are forward-looking, so they are enthused.
That's
of course, but I must mention this, that given the gravity of situation in terms of growth and all cylinders of growth, consumption, investments, exports, I'm sure we'll have to do a lot more. There's a lot that has been done. Finance Minister earlier listed several of them, but I think there is a lot more that we need to do over the next several months, and I'm sure markets are going to keep a very close eye on all of those steps.
That was a very mutual fund manager answer. Coming from someone who, by the way, his fund has been the best performer in the last decade. We were just digging out the data. SBI Mutual Fund, big round of applause for them. But Bala, let me come to you. That was the rhetoric answer. On paper, yes, everything is okay. But if I just bring up the last month's AMFI data, besides the retail inflows, the data is not seeming all that great. What's keeping investors at bay? Is it just the sentiment? Is it just the lack of animal spirits? Because if I look at other asset classes, be it fixed income, be it real estate, or for that matter gold, none of it is working. Then what are people doing? Are they just sitting on cash?
I think the function of, if you look at last 6-7 years, then we had one of the highest growth, both in terms of AUM as well as customer addition. The number of new customers who have come in the last 4 years is one of the highest, especially post 2014. And post demand, I think further improvement that happened on customer additions. And if you look at the market return, leave aside Nifty or maybe Sensex, I think money has come in the rest of the market, and one has to of course look at how the schemes have performed, how the equity markets have performed the last, not just only 1 year, look at say 3-year period. That's a function the way it always happens. For every market starts with one good period, then it followed the one bad period, again good period. If you look at the 10 years return has been good, but if you look at a 5-year return is pretty decent. But if you look at 3-year return could be weak. If you look at a 1-year return is good. I think we go through that cycles.
Did you say 1 year good?
Yeah, 1 year of course is not that bad. So 1 year is still positive actually. If I look at the same 1 year return, roughly about say 6 months back would be negative, would have been negative. I think that again investors see it and then say, okay, now I've come actually the last 1 year, what is my experience, 2 years, what is my experience? And especially in SIP, especially in this kind of period, normally in one trended upward cycles, of course SIP does give superlative return. At the same time, the market goes through ups and downs, it gives of course a moderate return. I think it's a function of that. And second is, I think as Navneet mentioned about it, but everything is driven by hopes and optimisms and also the sentiment. And whatever certain in the last 1 year has been one of the toughest years. Though many people did not understand the impact of the ILFS crisis in the financial market, and people took some time to understand, including the regulators, including the policymakers, did not actually pay much attention to the potential impact the fall of ILFS would have in the financial service industries. Nobody expected that. I think it's kept on actually moving on from one to other and just came, even today also we are still struggling with fixing some of the issues. And there is a fallout of that. The fallout of course is the comments in the economic growth slowdown, and there is a fallout on terms of confidence being low, and the fallout is actually on the basis of the confidence in terms of lending to each other has also been relatively low compared to what we have seen in the past. So that something is also ultimately has to somewhere result in growth and then subsequent the market and so on and so forth. And again, the broad market, I think always the surprise is there, the broad market does well. And the broad market is a function of the money flow that's coming, as well as Navneet mentioned about the recent past, the government has started addressing some of the issues in the form of tax cuts and many other things. So therefore, it is now building up some kind of, not animal spirit, so to speak, but at least some bit of optimism coming back. I think we are at a stage where optimism is coming back, and probably it's followed up with some bit of pickup happens in the rural economy, thanks to the good monsoon. And then the budget, ensuing budget that is there, it starts pushing up some of the supply, demand side, the issue that they have to address it, the form of picking up the demand that through some kind of tax cut and other things, then we'll probably get into the animal split. I think the function of, generally my belief is every 2 years of bull market should follow with about 18 months of, or 2 years of bear market or maybe flat market, again, so on like that cycle. And in the mutual fund industry, the biggest thing that we have seen in the last so many number of years being in the industry is at every point of time we start looking at silver lining, and at every issues followed with one silver lining. And what we believe that I think is today the silver lining is there in the form of the lowest interest rate that's possible, which I think would make investors think about now let me come back to equity, let me come back to fixed income, let me come back to other asset classes because the interest rates are low.
Sunil, how important is it for a mutual fund investor to stay put, to ride the cycle of a bull and a bear market, keep the time horizon long? I know, these are things that we talk about day in and day out. It's easier said than done. But like Bala was saying, if you were to draw up a comparison of the market return or the mutual fund industry return in the last 10 years to 5 years to 1 year, the difference is staggering. The importance of just staying put, being patient, investing is the most boring thing to do, as opposed to trading, perhaps. That's where the thrill and the excitement is. Emphasize for our viewers, I don't know how many of us really are equity investors. If I ask anyone to raise their hands, maybe only 20% of the population would raise their hands, even in this hall here. The importance of just being patient and staying and keeping at it.
Absolutely, because I think one of the key things in India is that we don't have a social security net for our investors or for our people. So people have to build for their own inflation-beating return. And I think the people have to simply keep in mind that inflation, the only asset guaranteed to beat inflation over the long term is equity, for the simple reason that demand and supply leads to inflation, right? So your suppliers are the ones who are listed in the stock market. So when inflation is rising, that profit is actually passing to the suppliers who are the ones listed. So the easiest way to make people understand that you face inflation, onion prices rises, you start rona dhuna. The easiest way to explain to people to say that ultimately there's somebody who produces. I mean, onion is like a agri commodity, but anything else, a manufacturing company or a service company has to deliver that. And that inflation which you are suffering as a customer is straight away going to some corporate, and the equity market is giving the value of that. And like when Bala was mentioning, you take a 15-year track record, the earnings growth of the economy, right? Nominal GDP growth has been around 12 to 15%. The EPS growth of the stock market has been 13%, and the stock market has done 14%. So the longer term, equity is the only asset guaranteed. And like you said, boring investment, the best way, because I think SIP as a concept, I think if people looked at SIPs as a savings EMI, I mean, for everything, for a drop, for a credit card payment to buying a house, you think of an EMI. But if you simply adopt a tactic that every month from my income, I first decide what I save, and then only I go to spending, right? That's one. Second, think of that as an EMI which you can't alter. You fix that up. And I would suggest the third thing is everybody goes through increments and increase in salaries. Every 3 years, you just increase your SIP by 50%. You're guaranteed to be a crorepati in 15 years, right? So I'm just saying that, so for people to think about it, it's just a very simple equation that all my mehengai ka impact somebody is enjoying. Equity markets is the simple route for me to partake of that enjoyment. And to do it systematically means two things. One, you are making sure that your income comes monthly, your savings goes monthly. So while they say about rupee cost averaging, power of compounding, leaving all that aside, when you're getting your money in monthly, best to save it monthly. And in the process, what you achieve is all the intermittent volatility actually gets you more units, right? And that's the simple cause of rupee cost averaging. So I think just these three mantras, I think, are good enough. And I'm sure everybody in this room, right, they would realize that the little drops make an ocean. So SIP is the best way where you don't feel the pain. You don't have to make a big investment decision. Or is equity the right asset class? Is gold the right asset class? It's just simply salting it away every month. And suddenly one fine day, you'll find that, crorepati, kaun banega crorepati is not necessary. You yourself become a crorepati.
Okay, 15 years is all it takes, not one episode. Ashutosh, at an average of $2,000 per capita income in the Indian households, why is it that only a minuscule amount of that household income finds its way to equities, and within equities also not direct equities but SIPs?
Good question, actually. If you think about it, there has been such a obsession in India with real assets. And not surprising, we've lived through centuries of, let's say, not necessarily being well off as a nation, as a population, and therefore physical assets is something you feel, you touch. Clearly, for example, gold has been a very high obsession with India, largest buyers of gold in the world. We continue to be, we produce nothing. But if you think about this, that's a kind of a historical perspective. But if you think about going forward, we started this business thinking we are joining the party late. We are like 44th player in this game. Why did we do this? Because there is something that's happened globally which we believe must happen in India. It has got to happen. If you think about just the discussion before this, we were discussing India is a capital-starved nation. Where does that come from? The capital is lying in the real assets. If you just take gold, between the Indian Homes and Indian Temple Trust, we own 27,000 tons of gold, the largest owners of gold in the world. Put a rough number to that, it's about what, $1.5 trillion worth? We talk about creating infrastructure for India in $1.5 trillion. That's lying in people's homes, a dead asset. So clearly, we think that capital has to come to the capital market from homes. This is exactly what's happened everywhere in the world. If you take the bigger markets, take the US, take Europe, take UK, take Japan, not China yet, these are markets where more than 50 to 60% of homes are contributing their savings via the fund into the capital market. It's via the open-ended funds because they feel they take care of them. They take care of the administration and governance of companies where they invest. So there's a confidence built in people's mind over periods of time, over decades, that this is the right way to contribute capital and, like Sunil said, to take care of my personal inflation target. But the nation creates capital. We believe that that's got to happen in India. The journey is just begun, and I must say, sitting on this panel, there are at least 2-3 people, including Bala, who led the campaign of mutual funds here, getting people to understand that they don't have to stay parked in physical assets. That's where the asset is doing nothing. It's not earning anything. If you take rental yields in India for all the land we own, do you know that on an average household level in rural India, 156 million households own 0.73 hectares of land each on an average. Most of it does nothing for them. It's not even cultivable. We have to be able to get out there and take a message to people that you must convert this into financial asset. And the way to do this is pretty much what's happened rest of the world. Buy yourself a good mutual fund over a long period of time. You make wealth. Capital comes to people who need the capital. So according to me, that's the way forward. Will it happen? Yes, messaging is important, and I think we are doing a lot about messaging. What's stopping? At our company, we find that being able to go and sit next to a customer, to explain to him that, look, this is what you got to do. This is the risk you'll have to take. A lot of people tell me that, you're starting a company, you're saying you're going to sell mutual funds in small markets, in rural markets. Do people understand risk there? And I put it to you that nobody understands risk better than the farmer. He takes a risk every time he gets out of his house. He doesn't know whether it's going to rain. He doesn't know when it will rain. He doesn't know whether he's going to have his seed popping, or there will be a drought, or whether there will be some kind of invasion by locust. When he finishes taking the crop and he goes to the mandi, he doesn't know what price he's going to get. That guy knows how to take a risk. He takes a risk every day. We just have to explain the risk to him in his language. If we do this, there is a lot of capital to come via mutual funds into this business.
Kalpen, is that the biggest roadblock? Is it the psychology? Is the risk-averse nature of the Indian, which is keeping the potential of the mutual fund industry at bay?
Partly yes, because investors don't necessarily think as rationally and cold-bloodedly as money managers who preach to them that you should come and invest. And obviously they have their own lives and they're busy with that. So for us to expect that they will wear our hat and think rationally is unfair. And which is why we see money coming only in upcycles. So I have this view that had the mutual fund Sahiye campaign not coincided with the rise in markets between 2014 to 17-18, the outcome may have been a bit different. And in the last 2 years, the volatility of markets is slowing down. So like in every industry which goes through a cyclical slowdown, the same is happening here. What we need to continue to build up on the good work that the industry has started in the last many years, compliments to you guys also for the campaign that you are running, is simplify the messaging. And the messaging has to be candid, honest, and a two-way messaging, and not a one-way messaging only showing upside. Because 50% of time markets are down on a daily basis. 33% of time markets go nowhere, 33% times they go down in long cycles, and in the rest 33% times they catch up. But if the wiring to the investor is that every time you invest you'll make money, and then he says that, okay, in FDI I was making 7%, but now in SIPs I'm making only 3%, he feels let down. So one is the education. Now education is not easy. We all know education is boring. So how do we bring simplicity in messaging, entertaining and engaging way of educating is one way to solve for this, number one. Number two, I feel more confident today than ever before. While volatility will continue, there may be years perhaps when monthly flows could be negative like last month. I can't predict that. I have seen 4 or 5 years where flows have been negative. So why should that not happen sometime in the future? It may happen. How do we need to prepare for it is primarily by creating pipelines to reach consumers. And that process has started in a very systematic manner in the last 2 years with emergence of lot of digital platforms. There are many unknown digital platforms today who in a month are acquiring 20,000 SIPs per month, more than what many large physical platforms who have been doing it for 20 years but still not reached that state. So I think the transformation is structural, that as consumers we need to invest. There will be periods of cycles, but two things that the industry needs is constantly build distribution. The reach to reach customers, number one. And number two, when that reach is being built, parallelly build up on authentic, simple, and entertaining messages to make consumers realize that what is investing all about. And I'll give you one example from my own career of 2 decades. The first 7-8 years, I used to feel very good when markets would rise. So large part of my career, early days was between 2003 to 8. So it was almost a one-way journey. And somewhere in 2008-9, some wise, senior investor sent a quote to me, which was a quote by Warren Buffett, which said that if you are a consumer of burgers, would you want prices of potatoes and breads to go down or go up? And that was like a turning point, that ideally, if I'm a consumer for the next 30 years, and I'm a salaried employee earning every month, I want for 29 years the prices to go down, and in the 30th year, let it go up. Now, thankfully in India, the population that we deal with is a young population. Of course, people who are invested will not feel happy. People who are retiring will not feel happy. But if we can teach to our investors that volatility is truly a friend, a lot of transformation can happen. And that itself will make investors last through cycles. Lastly, our industry needs to move away from obsession of only equity funds, but look at multi-asset products, which have equity, fixed income, gold, and we manage all these asset classes. Mutual fund is not only equity. 50% of our AUM is fixed income. So if interest rates from 9% have come down to 6%, and for some reason, if assumed they go down the way they have happened in developed world, even fixed income can give meaningful inflation-beating returns. So if we are able to do these 3-4 things together, the journey can be less volatile and less cyclical for the industry, and the investors will be more mature.
Right. Navneet, at 8 lakh crore rupees of SIPs, what will it take for the figure to double? I'm not putting a timeline to it. I'm just asking you, what will it take
So it
for
has
the
to
figure
be
to double?
much larger. I mean, think about it. We are going to be 5 trillion, a year, whatever, a year or two here and there. At $5 trillion, do the reverse calculation, 35% of investments. Then what is the savings need? How much of that you can borrow from foreigners, right? I mean, we already have, if you look at our overall savings from foreigners versus domestic, there's already a large gap. You cannot continue that. We are not a structural current account surplus, whatever country. over a period of time, I think we need to take this amount substantially higher. At 1 lakh crore is almost the same as the divestment target of the government. Where is the savings left for the private sector? The total financial savings in the country is around 8 or 9% of GDP, which is the borrowing by central government plus state government plus most of the PSUs. Where is the savings left for the private sector? We have severe shortage of risk capital. Every single regulation, every single policy that we are framing, we must keep in mind that we have a severe shortage of risk capital. And what do we do to get more risk capital into the economy, which is very, very critical. And I'll take 1 minute for this. For this $5 trillion economy, I strongly believe that, as SPM has said, that there are only two classes of people. People who are poor, people who want to help poor. And I think our industry, mutual fund industry, hasn't thought on those terms that we can play a very significant role in reaching that 5 and also ensuring that growth is sustainable and equitable. That growth is distributed among large number of people, because in a democratic setup, if growth is not equitable, it creates another several challenges. And I think if we focus on most of the other challenges in the economy, so whether it's climate change, whether it's inequality, whether it's lack of innovation, which is a serious problem with India, which is the reason why our exports are not going up, and we have several other challenges. In all of those issues, our industry can play a very, very significant role in terms of the way we allocate capital, number one, and the way we engage with businesses. And I think if we do that, there is a reason to believe that we will create an asset management industry which could be world-class. Think about it. I mean, we manage more than $100 billion today between mutual funds and PMS. Over a period of time, even at the current growth, we'll be one of the larger asset managers even from a global standard. You think about when we go to 5 and 10, why can't we aspire, our industry aspires to do something what we have done in the IT industry. 25 years, Manish is sitting in front of us. Who would have thought that this industry is going to be $1 billion? This is more than 100 billion. I think if we get our act together, this industry can actually also play a similar role where we can be a large asset management industry, even from a global standard, and can actually use that for a lot of foreign exchange earnings. I mean, we have like $500 billion from foreign asset managers invested in India. A fraction of that, maybe 1 or 2% invested through the local asset management industry. Why that amount should not be larger? Today, all assets in India, the prospective buyer is some large global fund, because I mean, you have a shortage of risk capital in India. Why the entire financialization of assets, which India is likely to see in next 5 or 10 years, why can't we play a larger role in that? So that's through the alternative investment industry. So I think our industry can play a very, very significant role, and I think we need to rise to that occasion.
Absolutely. Bala, and I could see the twinkle in Navneet's eye when he was talking about those $1 trillion figures. But really, you know, like Navneet was saying, that you got to tap the potential outside the metro cities. What would it take for mutual funds like you to really go to the grassroots level and urge them to invest into mutual funds? Because I guess the higher alpha generation will happen when mutual funds penetrate beyond the metros.
Yeah. I think this is where I think the way I think the industry went about approaching the expansion as a strategy. I think thanks to SEBI, as well as thanks to the members of the AMFI, who jointly actually came with the theme called B15 and T15. And today B15 has gone to B30. The moment you actually put a set a target that you need to go beyond 30 cities, then naturally every player in the industry starts going and actually is making the effort to build the market. I think one of the biggest things which I think you mentioned about mutual funds is not about what messaging you are giving, is about actually making a feeling that you must go to those markets and start expanding, create an awareness, and so on and so forth. And believe me, in the last few years, what you've done is only scratching the surface. As you move forward, I think there is a clear mandate that has been given by the regulator that the 2 basis points of industry education money has to be spent only on educating investors. That is, believe me, even the one which you run on your channel, which is the Johnny Wage, is more targeting towards getting every customer actually to own mutual fund industry. And I think if you approach that way, and also make people understand the power of company in the mutual fund is real, it's not actually illusions, it's not just only in equity, even the fixed income if you take it, and compare that with any other classes where any rural investors are putting money is only in the real estate, and they look at the power of compounding there, vis-a-vis the power of company here, and combined with the liquidity that is being offered in the mutual funds, I think people will start understanding that. I think, again, the third, which of course is happening, is the financial service industry is led by the banking industry, also now moving towards making mutual fund as one of their part of the system for distribution to every customers who are own actually their fixed deposit. I think the time will come where you'll probably see the current unique customer base of 2.2 crores and 7 crore folio that you have, maybe it can double in next 3-4 years time frame.
Yeah, absolutely.
One of
Yeah,
the
you wanna
facts which
make-
is not known is that crores of people have joined mutual fund indirectly through the pension fund. So almost like, I guess, more than $15 billion have come into equity in last 3 or 4 years. And there are millions of those subscribers of Provident Fund who've got exposure to equity indirectly. So we look at the folios in the mutual fund industry. If you add that, then the growth numbers are slightly different.
So the Josh remains high.
Yeah, that's right.
Okay, hopes at least remain high. But we're going to wind up this discussion on that note. Thank you all so much for taking the time out and speaking in. Oh yeah, okay, we have an audience question. Can we just have the mic passed on?
Hello everyone. These are all my good friends. So, we just talk on a daily basis. So, Navneet, you talked about two categories. You talked about two categories which the PM talked about, poor and those who want to help poor. The question which we are getting from our audience and on Twitter handle is that there is another category that we've become poor after 3 years of investing in mutual funds. Right? Returns have not been there.
That's not true. That's not true,
He'll
Nikunj,
say if
at
you
all.
invested my
He
streams,
just
no, you
started.
wouldn't.
No, in the entire mutual fund industry, I think if you look at the track record, I'm sure those numbers have got quoted by everybody in last couple of minutes. And I think over a long period, mutual funds have generated decent wealth across all categories. In fact, in last 1 year, Bala briefly touched about the ILFS issue, and then we had several mishaps in terms of NBFCs and HFCs and some of the other corporates. You look at the returns of the credit fund, on an average is more than 7%, which is, on an adjusted basis relative to any other revenue, investors have done pretty well. Also, we have to adjust our returns and the inflation has fallen to 3 or 4%. So in real terms, returns have been pretty decent over the last few years.
Sunil, you want to make a point to that?
What I wanted to say to Nikunj is that the people who say they will feel poor are the ones who exit the mutual fund the wrong time. If only they didn't do that and they stayed, you know that, right? 1 year back, if you'd seen to now, if you just stayed, the market has made up all the losses today. And right?
You mean those 10 stocks?
Yeah, and I'll tell
Yeah.
you this, you take any, there are 400 odd equity mutual funds in the country, right? And I challenge you to do this analysis on a rolling returns basis. Anybody who stayed for 5 years in anything other than a sectoral fund, okay? Any diversified, and there are 400 of these in the industry. Never ever have they lost money in the history of the mutual fund industry. All you need is golden mantra, stay for 5 years, regardless whether you came in 2008 peak and left or 2013 bottom. The industry has made sure that never ever has a single investor lost money if they had only stayed for 5 years. So I think that people tend to read into disappointment and take out the money when they make a loss, then they... So the choice is in your hands on whether you want to become poor or you want to say that there is a sign of poverty, but if I stay there, I will become rich. So I think it's only a mental thought process, Nikunj.
I'll wait till
Why
I
are you
get
challenging
rich.
Nikunj? He's on this side only. He says it every day. We come on TV and say like once in a while. Nikunj does it every day on our behalf. Mutual fund sahi hai. And I think one of the brilliant things over the last few years, we discussed that in last 5 years, we have made a tremendous progress as a country in Jan Dhan Yojana, financial inclusion, taking it to the next stage, which me and Nikunj several times, and Aisha, some of us have done that, is a Jan Nivesh Yojana.
Correct.
That we have to take it to the next level where people not only open a bank account and get a debit and credit card, but participate in the growth story of India. So thank you, Nikunj, for asking and saying the same.
I think-
Asking us and getting the same answer which you do every day.
I think he was playing devil's advocate there.
We're in an echo chamber. Kalpen, just very quickly before we wrap up, you wanted to say
Nikunj's response, it's a very interesting question, but it is, the tweet that came, but there's a lot of cherry picking here. And on this floor, there are, I think, 3 or 4 mutual funds with 20-year history. We have funds with 20-year history and roughly around 18 to 20% CAGR. Of course, last 20-year return may not replicate, but the number of investors who have captured that 20% investors will not be more than 1% in all our funds. So again, the value of time, number one. Number two, the 12 lakh crores or 14 lakh crores, which is in equity funds, has not come 3 years back. So the 3-year return being negative is relevant for a segment which has invested 3 years back. But there are many investors who invested 1 year back, 5 years back, 7 years, 10 years back. So if we aggregate at large, There are enough investors who have done 2x or 3x of inflation. So cherry picking one data point is unfair. Number two, I always tell investors, and I'm myself an investor, so it applies to me also, if you invest only in market peaks and question the principles of investing in market lows, you will remain poor. You should not be a mutual fund or an equity investor then. The duty of an equity investor is to invest across cycles and not cherry pick and get swayed away.
That's a brilliant response.
You know, Aisha,
It'll completely shut up all the trollers.
No. I think the idea was really to get into an engaging conversation as a channel, as a firm. We completely believe in mutual funds. I think all of us are big advocates. I would like to also accept that I am a mutual fund investor, and over the years, the wealth which Indian mutual fund industry has created is far greater than what any other mutual fund industry has done. So thank you very much for making Indians rich. But when you look at a 2-year, 3-year kind of a time frame, well, we can't sugarcoat that. That you'll agree with me.
Go ahead.
One last word on this. So since we sell to very small investors in villages, the only thing we do is to tell them, you set a goal. Don't set a time frame. Set a goal. What do you want the money for? And believe you me, most of the people want money to send their children to cities to study. And that's a goal. And typically that's not a 3-year goal. So by and large, if you set a goal and not a time frame necessarily saying 2 years later I'll get out, chances are you're going to get away with a decent amount of upside. So if you teach people to behave to their goals, financial responsibilities, generally speaking, mutual funds play a very, very good role in that kind of a situation.
I have a
Before we
query.
get more Twitter questions, we're going to wind up right here, gentlemen. Thank you so much for taking the time out.